Welcome to Markets Now. I'm Michelle Rook along with Oliver Sloat, Blue Line Futures. Mixed trading, both grain and livestock futures today. And let's pick this market apart. First of all, corn market, we made new lows and then kind of bounced into the close. Oliver, what do you make of that? And what is it going to take to put a harvest low in, do you think?
Well, it was certainly a silver lining for the bull camp to see some green on the screen, especially from the prior 3 days where it was red, 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 and nice to see a rebound. But the bulls still have their work cut out for them. We need to get back out above 472 with some consecutive closes to have the potential to potentially spark some short covering from the funds who hold their largest net short position since 2020, 135,000 contracts short. So obviously they've been adding to that position, and rightfully so, because the demand side of the equation just hasn't been there. And people are talking about the yield not being there. Well, demand isn't there either. We need to see demand pick up. We need to find a price where demand starts to pick up, and we haven't gotten there yet. So maybe we see a little bit more downward pressure, but quite frankly, I don't know that it's going to be all that much. I was talking with clients today. I think you probably trade 15 cents on either side of 470 seems like a likely scenario at this point. But, with harvest just 9% complete, those things can change and those yield numbers can change. So it's going to be interesting to see what comes out of the field as harvest really kicks into gear this week.
No doubt. Obviously, we anticipate harvest pressure this time of year. Do you think there's a lot more downside risk, especially with the 2.2 billion bushel carryover hanging over our head, or not?
Well, that's what really worries me. So seasonally, we can try to carve out a little bit of a near-term low from now to beginning of October. But I think the thing that kind of keeps me up at night, or would keep me up at night if I was really bullish, would be the 2013 comparison, where we just continued to drift lower from here to the middle of November. So with that big of a carry out, again, I think the risk to the downside, is there. I think the risk to the upside is there too, but I think both are fairly limited. So I wouldn't be surprised to see us just chop around. And I think the market's probably suggesting that as well. If we look at the volatility levels and where volatility is trading, volatility is at its lowest level since the spring. And the options aren't pricing in a lot of fear or uncertainty. And that indicates that I think we're probably settled into a little bit of a range down here in the 470, again, give or take 15 cents on either side.
Certainly, it would help if we could get the wheat market to really stage a bottom. I know that's been a headwind for that market. What are you thinking about wheat? Is it just that we have too much of that cheap Russian wheat that keeps keeping a lid on prices, or do the specs just want to keep selling this thing from a technical standpoint?
Well, I think both. The funds have been pretty resilient in defending their net short position. They're short about 84,000 contracts right now, which seems like a lot. But remember, going back to May, they were as short as 126,000 contracts, which makes you kind of wonder if they're going to get back to that type of level. I don't think they will. Seasonally, again, we start to carve out a little bit of a low here. Looking at the global stocks to use ratio, we're projected to basically come close to the all-time low, which was back in 2007, 2008. So I think there's some potential bullish headlines coming around the corner, but we've just got to get there. And I think a lot of that will start with some technical trade, right? $6 is obviously the psychological barrier that a lot of traders are keeping a close eye on, but 610 to 615 is really the level that the bulls want to get back out above to encourage some of that short covering and spark a bigger rally to the upside.
And speaking of technicals, soybeans have done some technical damage here, haven't they? How much more do you think we're going to see in terms of fund liquidation there?
Yeah, so a break and close below the 200-day moving average is not what the bulls wanted to see. That's at 1330. So that previous support level is now going to be resistance. A failure to get back out above there, I think, keeps the bears in control as we head into October. On the downside, $13 psychologically significant. 1304 is a 100-day moving average. We stopped just above that in the overnight and early morning trade. My fear is that we go revisit that, and that leads to another breakdown. So the next target we'd be looking at below $13 is 1280, 1282. That represents a spike low from August 8th, as well as a 50% retracement, which is basically just a neat way of saying the middle of the trading range from those May lows to the July highs. So I am concerned that there's probably a little bit more harvest pressure here for soybeans going into October, which kind of fits in line with the seasonal aspect as well. But if we did get that breakdown to 1280 with where the balance sheet is right now, I think that would probably represent a pretty good bargain buying opportunity.
Absolutely. That should be a value level for sure. Cattle market, new contract highs in live cattle, then we ended lower. Was that hedge pressure or profit taking or what?
A little bit of hedge pressure, a little bit of profit taking. We've got a big Federal Reserve meeting tomorrow, Wednesday afternoon. That's going to be something to keep a close eye on as it kind of impacts a lot of different commodities, especially ones where consumer demand is such a big player as it is in the beef market. So, the Monday, Tuesday pullback in the cattle market, yeah, it's a little bit of a caution flag, I guess. But if you zoom out, really all we did was erase Friday's gains. Funds have been defending a large net long position going back to April. They're long about 98,000 contracts right now, but they've been holding out above 80,000 contracts since April. So they haven't had any reason to exit that. I don't know that there will be anytime soon. Seasonally, maybe we see a little bit of weakness here, but I think ultimately we chop around. I wouldn't be surprised to see one big push higher in these cattle markets, kind of similar to what we saw in 2014, where I think, unfortunately, a lot of people, got squeezed out of short positions, and ultimately that led to a little bit of a blow off top, and we haven't gotten that yet.
No doubt. Cash trade last week was strong. Do you anticipate we'll see a follow-up this week or not?
Yeah, on the cash side, I wouldn't be surprised to see the market stay steady, maybe firm up a little bit, and that probably keep prices elevated. Again, I think this is just such a strong market, and I always tell guys the trend is your friend, and that trend has been up and to the right in terms of the chart. So I wouldn't be surprised to see us continue to hold ground. Maybe we dip down to 185. That was previous resistance in the December contract. That also represents the 50-day moving average. So that would be a level I'd be looking at as a potential inflection point for the market. Would act as support on the first test, but a break and close below there. And maybe that's what it takes to spark a little bit of that long liquidation that we talked about.
Gotcha. And the hog market chops back and forth. Today we're up, but we're still overall in kind of a sideways pattern, aren't we?
Yeah, we've just been choppy, chop, 71 on the downside to 77 on the upside. I wouldn't be surprised to see this market maybe make an attempt at the 200-day moving average at 78.5. I think that's probably going to be limited to the upside there. So I wouldn't be surprised to see the sideways trade continue. Just really hasn't been a whole lot to write home about. We talked about volatility in some of these other markets. Volatility for lean hogs is almost at all-time lows. So the market really doesn't know what it wants to do right now, and that's indicated by volatility as well as just the price chart, where we really haven't gone anywhere too fast. So what the long-term picture holds, I don't really know. I think you could make the case either way, but we'll just have to wait and see what other news comes out to give us new direction.
And finally, you mentioned the Fed meeting tomorrow. Do they take a pause here, Oliver? And if they do, how do the outside markets or the equities react?
Well, the expectations right now are to hold firm at 5.5%, which, keep in mind, is still at a 22-year high. So that's going to be something to keep a close eye on. What I'm really focused in on is this energy sector, the crude oil market in particular. We traded to our highest levels in the crude oil since last November. And when you look at inflation, the energy is such a big player in inflation. So if we continue to see a rise in energy, that's going to lead to a rise in inflation and potentially lead to the Fed kind of keeping the pedal to the metal in terms of raising rates. Now, I don't expect that in tomorrow's meeting, but further down the pipeline, certainly a possibility, especially if crude oil continues on its way higher right now. Higher rates for longer could potentially be a catalyst that spills into some of these outside markets and pressures things a little bit here towards the end of the year.
Definitely something to keep an eye on. Thanks so much for joining us, Oliver Slope, Blue Line Futures. That is Markets Now.